The live trading price for Plug Power Inc., under the ticker PLUG, is currently at $2.95, reflecting an intraday movement of plus $0.07 or an increase of plus 2.43% from its previous close of $2.88 on October 24, 2025. Now, while a plus 2.43% bump might seem like a straightforward recovery on a stock that has been under pressure, the real story here, the piece that should immediately capture your attention, is the sheer volume that has accompanied this move. We are seeing almost 81 million shares traded today, which is still a little below the 30-day average of 100 million shares, but it's a significant block of shares changing hands, particularly after the stock experienced a sharp downturn earlier in the week. This high-volume activity suggests a deeply conflicted market, where a massive amount of retail and institutional capital is actively debating the future of this hydrogen pure play at this crucial sub-$3 level. The market narrative for Plug Power has been, for some time, a simple binary bet. Either the company successfully transitions from a high-burn technology developer to a profitable industrial gas and equipment supplier, or it drowns in its own cash burn and dilution. Investors expect a volatile stock, but what they may not fully appreciate is the complex set of near-term contracts and the aggressive cost-cutting measures that are finally starting to align in a way that creates a genuine inflection point, a reality that the recent price action, specifically the defense of the $2.87 intraday low today, may be starting to signal. This is not just a speculative jump. There are fundamental, execution-based developments driving this churn. The general belief, particularly prevalent in online investment circles like Reddit forums and X-Twitter discussions, is that Plug Power is a growth-at-all-costs story, perpetually hampered by negative gross margins and significant cash outflow, a reality that the recent quarterly earnings report underscored with its net loss of over $227 million. This prevailing expectation paints the stock as an extremely risky proposition, dependent solely on government subsidies and a hydrogen infrastructure build-out that is slow to materialize. However, the contrarian or deeper take must focus on the operational reality that is evolving beneath the surface of the loss statement. Plug Power is demonstrating improved execution capability on its hydrogen network. The recent announcement of its partnership with Edgewood Renewables for a renewable fuels facility in Nevada, which moves beyond just hydrogen into sustainable aviation fuel and biomethanol, is a critical development that challenges the singular hydrogen-only risk profile that the bears harp on. Furthermore, securing a follow-on mandate to deliver an additional 35 metric tons of green hydrogen to the H2 Cast project in Germany after successfully completing the first phase is proof that their logistics and supply chain execution in Europe is maturing. These are not headline-grabbing, sector-shattering events, but they are concrete, on-the-ground wins that point toward a functional business model beginning to scale, which is the necessary reality check against the expectation of perpetual failure. In terms of stock movement, the daily chart shows a considerable amount of back-and-forth drama. Earlier this month, we saw the stock experience a massive rally driven by bullish analyst upgrades, specifically one raising a price target all the way up to $7 per share, which created significant short covering action and pushed the stock's RSI well into overbought territory above 83. That sharp movement was followed by a necessary yet brutal cool-down period. This week's trading is characterized by the stock giving up a percentage of those gains, oscillating between the low 280s and the low $3. The volume today, while large, is not a panicked selling volume. It is indicative of accumulation around the $2.90 mark, suggesting a new floor is being tested and potentially established by institutional buyers who missed the initial leg of the run-up. Looking at institutional activity, we have seen firms like Vontobel Holding Limited and Crane Funds Advisors LLC recently increasing their positions. This accumulation by serious money indicates a belief that the risk-reward calculation has shifted, even while other large houses like Morgan Stanley maintain an underweight rating with a significantly lower price objective, perfectly encapsulating the tension between expectation and reality in this stock. Now, we must address the intense pressure from the short-selling side, which is a massive factor in Plug Power's volatile trading history and a constant topic of conversation for retail investors. Plug Power is a major short target. The latest data available indicates an extremely high short interest of approximately 383.76 million shares as of the most recent settlement date, representing a staggering short interest of over 34% of the float. This is an enormous figure, giving the stock a days-to-cover ratio, the number of days it would theoretically take short sellers to buy back all borrowed shares, of over 4 days, which is considered very high and signals a high potential for a short squeeze should a strong positive catalyst emerge. The short thesis is straightforward. The company is a cash incinerator that will continue to dilute shareholders through capital raises, such as the recent $370 million warrant agreement to stay afloat. And its technology, specifically proton and membrane fuel cells, is not cost competitive yet, making its profitability targets fundamentally unattainable. Firms betting on this decline are primarily pointing to the deeply negative profit margins and the history of missing profitability guidance. Investors should be highly aware of how to monitor this situation. First, always track the days-to-cover ratio, which is perhaps the most actionable insight here. Any sudden jump above 5 or 6 days without a corresponding rise in short interest might mean trading volume is slowing down, making the potential squeeze more powerful. Second, watch the short borrow fee rate, which, while relatively low recently, around 0.83% per annum, can spike dramatically when demand to short the stock increases, giving us an immediate read on real-time short pressure. A sudden jump in borrow cost is a direct signal that short sellers are aggressively taking new positions or that available shares to short are drying up. Retail investors should also pay attention to the failed-to-deliver data, as high FTD numbers can be interpreted by some on forums as a sign of coordinated short-selling activity or naked shorting, which feeds into the broader calls for market transparency often seen online. While FTD data is historical and requires a lot of context, a sustained high number is a sign of settlement issues that can add fuel to the community's fire. Do you think a high short interest percentage is a sign of smart money betting on a company's failure, or is it a calculated attempt to push the stock price lower through constant selling pressure? Comment below with your take on the rising short interest and whether you think it's smart money or manipulation. The underlying business of Plug Power centers on the commercialization of hydrogen fuel cell systems and the necessary hydrogen fuel infrastructure. Originally focused on material handling equipment, think forklifts and distribution centers for large clients like Walmart and Amazon, they have successfully built a closed-loop system offering their GenDry fuel cell systems and GenFuel hydrogen delivery and fueling infrastructure. This B2B logistics application is the profitable core of their operations, providing a stable foundation to expand into larger markets, stationary power, on-road electric vehicles, and broader industrial applications. Their model is vertically integrated, which means they not only manufacture the fuel cells and the electrolyzers, the devices that split water to create hydrogen, but they are also actively building out their own network of green hydrogen production plants across North America. This vertical integration is the source of the high capital expenditures and consequently the major cash burn and dilution. However, it's also the key differentiator. If they can control the entire supply chain, they can eventually control their cost of fuel and production, thereby hitting their long-sought-after positive gross margin targets. The company is guiding towards achieving positive gross margins by the end of 2025 and positive EBITDA margins by the end of 2026, a forecast that remains highly scrutinized but is supported by internal restructuring, including headcount reductions aimed at streamlining operations. Looking ahead, the future outlook for Plug Power is intrinsically linked to two major catalysts: the execution of their hydrogen production network and favorable regulatory action. The expectation is that the stock will continue to be whipsawed by every delay in a new plant coming online and every quarterly earnings miss. The reality is that the regulatory environment is providing an unprecedented tailwind. The Inflation Reduction Act in the U.S., with its clean hydrogen production tax credit, 45V, is the single most important variable. This credit fundamentally changes the unit economics of green hydrogen production, potentially turning deeply unprofitable projects into viable ones. The final clarity on how the IRS will implement the most stringent requirements, specifically the three pillars of additionality, deliverability, and hourly matching, will be a make-or-break moment. If the final rulemaking is favorable, the reality of Plug Power's profitability will exceed market expectations very quickly. Conversely, a strict ruling would force a massive reevaluation of their plant economics, leading to a sharp drop. Other opportunities lie in securing more large foundational contracts in sectors like data centers, which are rapidly looking for alternative reliable power solutions to handle the massive load of the artificial intelligence boom. The inherent risk, beyond the regulatory uncertainty, is that their ongoing need for capital could result in further shareholder dilution. The recent leadership transition with Joseph Luis Crespo, slated to take over as CEO, puts a strong emphasis on disciplined execution and cost control, a positive signal that management is prioritizing financial prudence over just pure growth. The main question remains, can the cost-cutting measures and the government subsidies arrive quickly enough to stabilize the balance sheet before the capital needs become too acute? The tension between the slow, deliberate scaling of industrial projects and the quick, impatient nature of the stock market is the engine of Plug Power's volatility. The recent strength shows a reality where some smart money is betting on successful execution and a favorable IRA outcome, an angle the majority of retail fear has not yet fully processed. The expectation remains that the cash burn will continue, but the reality is a pipeline of executed contracts and a major regulatory catalyst that could flip the economics overnight. This is why watching the $3 level, the short interest activity, and any concrete guidance on the IRA 45V credit over the next few weeks is not just recommended, it's essential for anyone holding or considering the stock. Comment below how many shares of Plug Power you currently hold or what price you'd need to see before considering a purchase. The collective sentiment is as important as the institutional flows in this particular story.